Here's a hot take. If you're a long-term buy and hold investor, then I personally believe that you shouldn't waste your time with index funds. And in this video, I'm going to go over why I believe investing in ETFs is a better option than index funds, no matter if you're a sophisticated investor or just starting out. If you find this video helpful, don't forget to toss it a like and subscribe to my channel for more videos like this one. Starting with index funds are a type of mutual fund that is passively managed and simply tracks the performance of an index. With mutual funds, there are two types: actively managed and passively managed. Actively managed funds have a fund manager actively making decisions and trading the stocks and bonds within the fund in an effort to beat the market. We won't be spending much time on these since I wouldn't recommend investing in an actively managed fund. They carry higher fees and there's no guarantee that they'll actually beat the market. On the other hand, passively managed funds like index funds don't try to beat the market but instead try to replicate some index or market. For example, a total stock market index fund like Vanguard's VTSAX aims to replicate the performance of the entire US stock market, whereas an S&P 500 index fund like Vanguard's VFIAX aims to match the performance of the S&P 500. Now, because index funds simply replicate an index, the fees associated are typically much lower than the fees that come with an actively managed fund. For some of the most popular index funds, they can get as low as 0.04%. This means that for every $10,000 you invest in an index fund, you would only need to pay $4 every year, which is a really low cost for the diversification an index fund gets you. And that is the other benefit of an index fund, the diversification. If you watch my other videos, you know that I talk a lot about how diversifying your investments reduces your risk. And when you invest in an index fund like an S&P 500 index fund, you get the benefits of having all 500 of those stocks in your portfolio without needing to invest in each of the 500 individual stocks in the S&P 500. Now, moving on to ETFs. ETFs, or exchange-traded funds, are very similar to mutual funds and index funds. There are actively managed and passively managed ETFs, but when I talk about ETFs in this video, I'm really focused on passively managed ETFs that track indexes like index funds. This way we're comparing apples to apples. Investing in passively managed ETFs get you the same benefits that investing in index funds get you. They're low cost with expense ratios that are comparable to index funds, and they can get you the same diversification that index funds can get you since ETFs track the same indexes. But the main difference between an index fund and an ETF is that ETFs trade on stock exchanges just like stocks. This means that the price of an ETF fluctuates throughout the day while the stock market is open. Index funds, on the other hand, have what's called a net asset value, which is the price you pay per share, but it only updates once a day when the market closes. So at this point, you might be wondering, why are ETFs better? They sound pretty similar to index funds. Well, let's get into the reasons why I believe ETFs are better investments than their index fund counterparts. The first is that you can get into ETFs for way less money up front, making them much more accessible as an investment option. Most index funds have a minimum investment to get into them, and these minimums are usually in the range of a few $1,000s. Not everyone has thousands of dollars lined up to start investing with, and with ETFs, since they trade like stocks, you can get started investing in them with as little money as you want to, as long as your broker supports fractional shares. Fractional shares give you the ability to buy fractions of a stock or ETF with whatever money you're willing to invest in case you don't want to put up the money to buy a whole share. Now, not every broker supports this, but the feature is becoming much more popular, and most big brokers like Fidelity do support this. The next reason why I believe ETFs are better investments than index funds is because they're more tax efficient. When you sell shares of an index fund, you sell the shares back to the fund's manager. The fund manager then sells the underlying assets back to the market, and if they sell them for a gain, those capital gains are distributed to every investor who owns shares in the fund. When this happens, those investors need to pay taxes on the portion of capital gains they received, meaning that if you hold shares of an index fund, you need to pay capital gains taxes, even if you didn't actually sell anything for a gain. With ETFs, on the other hand, when you sell shares of an ETF, you're skipping the fund manager and instead selling the shares directly to the market. And this means that you only need to pay capital gains taxes when you actually sell your shares of an ETF, just like with a regular stock. The last reason why I love ETFs is that you get all these benefits that you wouldn't get with index funds, and you can still automate your investments into ETFs. Most brokers offer the ability to automatically reinvest your dividends into buying more shares, and on top of that, most brokers also have the ability to set up automatic investments for any new deposits you put into your account. With these capabilities, it becomes extremely easy to set and forget your investments with ETFs and get your money working so you don't have to. So overall, while I believe ETFs are better to invest in than index funds, investing in either will benefit you more than not investing at all. What's really important is that you're saving and investing for the long term, since that is how you'll ultimately achieve financial freedom. So with that, thanks so much for watching. If you enjoyed this video, don't forget to smash that like button and smash that subscribe button for more videos like this one.